Let me also welcome in Karan Taurani, EVP at Elara Capital, to decode this for us. Karan, good afternoon and welcome to the show, and a pleasure to speak to you as always at NDTV Profit. Rapido, best known for bike taxis, now taking on Swiggy and a Zomato in food delivery. Firstly, how big a game changer is this according to you? And what would this do to the existing players?
Hi, good afternoon. I think if you look at Rapido, we believe that Rapido potentially can execute better in the food delivery business as compared to other peers. So let's get a perspective here. In the last 5 years, a lot of things have happened in the food business. Disruption in the form of Zomato, Swiggy going aggressive, acquiring the smaller players, becoming a duopoly until about 3 years back. And until about 1.5, 2 years back, we also saw entry of new players in, via ONDC. It could be Ola Foods, Tata Neu, direct ordering platforms in association with NRAI, ones like DotPay, Thrive. Now, the newer players were actually not able to scale up and do well because of two major reasons. Some of them had an issue in terms of lack of capital, because this business requires a lot of investment in terms of consumer experience, discount, promotion, technology, platform, everything put together. And the other reason was that these new players did not have a last mile. They were dependent on the third-party logistics players, which means user experience was kind of hampered there, and they were not able to deliver a better or on par user experience, with the incumbents, and that's why they've struggled to scale up, and some of them have even shut down for that matter. Now, what Rapido has got here as an advantage versus these players who made an entry in the food business over the last 2 years is that they have got the last mile. Right, so they've got a rider base, they have the last mile, which means user experience can be potentially on par with Zomato and Swiggy. Second is access to capital. They do have capital which can play out, which can be invested in terms of technology, user experience, discounts, promotions, everything put together. And the kind of capital investments they will require in the food business today, as compared to what Zomato, Swiggy required until about 5 years back, will be phenomenally low, because the online food delivery market has been created, the category has been created, is reasonably penetrated right now. You don't need to make the consumers aware in terms of online food delivery as a proposition. You only have to invest in terms of getting the customers on board and giving them a good user experience, and invest only on those aspects. So there is some probability that Rapido will be able to execute better as compared to other players who've tried to make an inroad in this business. And how they execute is a multiple. But in the near term, there is definite pressure on Zomato and Swiggy. Initially, the pressure could start off with, take rates, profitability, margins. And if Rapido scales up to a reasonable extent, it could also have a negative impact in terms of their growth rates if Rapido is able to gain market share. So near-term perspective, yes, there is some sort of risk for the food delivery businesses, I would say, but I would still watch out for Rapido's execution over the near term.
Right, Karan, this is Anushi joining in. So now, you explained about how Rapido could still be successful in this venture, considering that they have a wider rider network, which is not something that the other players had when Zomato and Swiggy were present. So considering these scenarios in mind, do you expect there should be some kind of earnings downgrade for, let's say, a Swiggy or Eternal, and consequently, they're being derating in terms of whether PE multiples are considered?
So we believe that, Swiggy, Zomato, the food business, the food segment rather, were given a very premium valuations, primarily because it's a duopoly structure market. You did not see any third player coming in, gaining market share and actually scaling up. So we believe that there could be a dent to valuation multiples in the food segment if a third player is able to execute well, and if this new player is able to scale up and get in economics on a very reasonable state. So that is definitely a potential. Second, as I mentioned, if there is a loss in market share to a large extent. So let's say if Rapido is able to gain, 4 to 5 percentage point market share in the next 2 to 3 years, it won't dent much. But let's say if they get to 10 to 12% kind of market share in online food delivery market over the next 3 years, it will definitely dent growth rates as well. So there is going to be a negative impact on a revenue growth. There'll be a negative impact in terms of margin compression because of take rates being competitive, and also a negative impact in terms of valuation derating. So I think putting all these things into perspective, we have built a sensitivity in terms of growth rates versus valuation multiple. So let's assume that Zomato, Swiggy are not able to expand margins from here on, which is as per their guidance, there's still potential for margin expansion over the next 2 years. Let's assume the margins remain stable, and the growth rates are kind of moving downwards from a 20 20% GOV growth towards a 15-16% GOV growth if Rapido does execute well, which will lead to a valuation multiple derating as well. So basis the sensitivity, what we believe is that the food business valuations can actually go down from 8% to 25%. And on an SOTP basis for both Zomato, Swiggy, largely, approximately 40 to 50% of their valuation comes from the food business, which means on an SOTP or overall target price basis, in a worst case scenario, you could see a 10% downside on target prices of both Zomato and Swiggy. But we would not look at the worst case scenario right now because Rapido has just entered this space. We would look for more proof of evidence in terms of their execution, their potential to scale up, gain market share, consumer experience, everything put together. So let's assume that let's take a midpoint instead of taking a 10% downfall in terms of target price. We would say that there could be a 4 to 5% fall in the near term, assuming that the third player just come in. And if things elevate from here on, if things kind of work against them, this downside in target price can basically increase from here on. But as of now, we would say that the share price valuations have been reasonable. There could be minor downside of 3 to 5% in the near term as well, basis this issue right now. But we would not assume a worst case scenario as of now because there's no proof of concept that Rapido will do extremely well in this segment.
And that's an interesting point that you're making as well. Now, we're talking about how the valuations will be cut, how the target prices will be cut. My question to you is, taking the recent fundraise that Rapido did, somewhere it has enough cash to burn. Would it be right to say that? And to counter that, do you think Zomato and Swiggy have that bandwidth to burn that quantum of cash to get in that race with a Rapido?
Yes, Rapido does have higher ability to burn cash because they're unlisted for now. Zomato, Swiggy don't have the ability to burn cash beyond a certain extent because both are listed companies. Both have a very big focus in terms of profitability because whatever premium valuation multiples both these companies are getting today is obviously because of improved margin trajectory and the guidance that margins will improve further from here on. So the kind of cash burn Zomato, Swiggy will do on the food business side may not be as high as compared to what a Rapido would do. That is the first thing. And I think Zomato, Swiggy will continue to focus on their moat, the user experience, which would be obviously better as compared to what Rapido is doing. But let's say if Rapido gets highly competitive, if the discounting increases and Rapido's user experiences on par with the Zomato, Swiggy, that is the fear moment, for Zomato and Swiggy to watch out for. And that's when they might, kind of increase or, elevate their spends in terms of A&P or in terms of promotion, or in terms of discounts, which will have a negative impact on their valuations.
So, Karan, I think the key investors with all of this want to know is what should they do if they are holding both the stocks, number one, or if there is further correction, would it be an opportunity to lap up a Swiggy and a Zomato? Let's look at both the scenarios.
So if somebody is holding on to the stock, we would advise them to, kind of hold it and also add at, a dip or lower valuation, because the entire thesis here is that quick commerce is a very large opportunity. In both these companies, we are definitely playing the food segment because 50% contribution does come from food in terms of overall EV mix. But the future is very bright as far as quick commerce is concerned. So if an investor is confident that quick commerce will scale up, eventually the food business contribution is only going to come off. That's the first thing. Secondly, as I said, there's no proof of concept of Rapido doing extremely well in the food business. It is very tough. These businesses have been built by both these incumbents 7 to 8 years. They've invested a lot of money, management, the kind of people they have, the kind of strategy they have. It's not going to be easy for them. So for now, I think if there is a fall in near term, I would add more, or I would rather kind of wait in terms of how Rapido executes from here on. In a worst case scenario, let's say 6 to 12 months down the line, if Rapido is becoming very aggressive, then I would still wait for a bottom in terms of fall. But at least in the near term, I don't see that situation happening. I don't see a worst case scenario playing out in the near term.
Moving on, Diageo, the parent company of United Spirits, is exploring options to sell part or all of its stake in the Indian Premier League franchise, that's Royal Challengers Bengaluru. United Spirits in its discussions to divest its ownership with a potential valuation of up to $2 billion for the franchise is what we've seen. What is interesting over here is this is coming at the time when RCB is at its high with the trophy. Let me go across to Karan to understand more of what his take on this is. Karan, how would you look at this? Because clearly this was, Vijay Mallya's baby. The transition has been very interesting. What would you have to say, your initial comments on this?
Well, we actually don't know in terms of whether or not United Spirits or other Diageo India wants to sell this franchise. But if at all they do decide to sell, I think RCB is doing very well right now as a team. They may well decide to sell it if they get a good amount of valuation. So let's look at the valuations here in terms of IPL teams. Because you had the media rights auction until about 3 years ago, that number actually moved up 2.5 to 3 times as compared to the last cycle, which means effectively these teams were able to kind of see a big escalation in terms of their revenue numbers. Because 80 to 90%, 80% rather of their revenue does come from media rights and 20% comes from ticketing and endorsements put together. So media rights revenue saw a big fillip, which means overall revenue growth amplified for these companies. Profitability margins were kind of stable because player cost is somewhere capped, and these companies potentially can make a PAT margin of anywhere between 30 to 40%. But if you look at the valuation part here, the new teams which were introduced, which is Gujarat Titans and Lucknow Super Giants until about 3 years ago in the earlier cycle, the valuation of these teams were pegged at about 900 million to $1 billion. Now, this basically is something which is low because clearly these are teams which are new in nature. They may not get that kind of profitability what these existing incumbent teams are making, right? So that is why the valuations are low, and we believe that existing teams could ideally trade about 1.2 to 1.5 billion dollars in terms of valuations because of being incumbent and because of having a better profitability. But going ahead, if somebody wants to enter the business, there's always a scarcity premium also which could kick in, which means eventually the selling of this team could also even happen at $2 billion odd valuation, if at all. So we don't rule out the fact that this is something which can happen. It can happen because there's a scarcity in terms of the number of teams that are going to come in this entire IPL property, and there could be a certain player or investor who wants to play this segment and will pay a premium valuation.
So Karan,
basis
sorry to interrupt
scarcity.
you, but you're saying a $2 billion valuation is a possibility, but it would be at the expensive end of the band, right? Because 1.2 to 1.5 billion dollars would be a fair valuation.
Yes, absolutely. That is our assessment. Basically, the growth rates panned out. Basically, the valuation multiples that you would give to this kind of a business.
And how do you think this is the perfect strategy for United Spirits as well to take the most of it? Because RCB was absolutely dry since the time the series IPL has started, and this is their high moment as well. You don't know where it goes from here on. So are they making the most out of the opportunity and make it a valuation game?
Yes, it could be, because if they get this valuation of $2 billion, it will flip valuation for the other teams as well. And we don't see RCB getting a better exit, at least in the near term, the next 3 to 4 years, beyond this valuation of $2 billion.
Karan, a quick question. Who do you think could be the buyer on this one? I'm sure no one's going to hold you, but who could you think could be the potential buyers? Do you think they will be from the Alcobev industry, or what could it look like according to you?
Doesn't look like that could be someone from the Alcobev industry. I think it's going to be some corporate conglomerate who wants to enter this space. As I said, most of these teams are backed by large corporate houses, and you will not see number of teams increasing beyond a point, which is currently at 10 teams right now. Eventually might become 12 teams in the next 3 to 4 years, if at all. But you will never see a situation of 20 teams, 18 teams. So whoever wants to get into this business will give a scarcity premium and want to make inroads into it.
Okay, Karan, so that's the whole update that we are seeing for what this update in terms of RCB stake could mean for United Spirits. But apart from that, even if you take the overall sector in view, I just want to understand your view in terms of how United Spirits is positioned as compared to the other Alcobev stocks which are there.
United Spirits, in terms of other Alcobev stocks, is reasonably placed. We don't see any big growth. If you look at the triggers in the near term, UK FTA was supposed to be a trigger for them, but clearly margins are dilutive in that segment, lead to better volume growth for United States. But because the margins are dilutive, re-rating of valuation multiples from current levels, and also in terms of any potential earnings upgrade, because even from a margin standpoint, United Spirits for Core Alcobev, the margins are more towards closer to 17%.
Right, so I think that's the status, that's where United Spirits sits at as well. But thank you so much, Karan, for joining us on the show and sharing your views. So that's with regards to what's happening, in the food delivery space, as well as with United Spirits and RCB.